course will be dedicated to disaster risk financing, insurance and reinsurance. And this session will be presented by three different speakers. I'm pleased to introduce Kirill Savrassov, who is the CEO of CRetro, Phoenix CRetro, private sector company based in London, as well as his two colleagues, Clive and Despoina, whom you can see on the screen. They will also be contributing to the session. Without further ado, I don't think I need to say it again, the importance of this subject. And for us, as I mentioned earlier, this is a relatively new practice area for UNDP, where we are trying to substantively engage with the colleagues and try to understand how we can move forward together. As I mentioned earlier, we have 2-3 countries in the region that have expressed initial interest. The governments have expressed initial interest to learn more, and hopefully this cooperation can continue. So Kirill, please, floor is yours.
Thank you very much. Ladies and gentlemen, thank you very much for the opportunity to speak in front of you. As Armen said, I will try to make this speech quite entertaining, because we are pure market practitioners, and I really believe that it is fundamentally important for academia and establishments like universities to liaise with real-life market practitioners to share the experience, because there is one saying in former Soviet Union countries: any safety instruction is written by blood, which means that all those safety instructions based on a real experience and real examples. They are not written for nothing. The same stuff is when private market is speaking to people working in international organizations and who are studying in universities. So it is very important to share mutual understanding and mutual experience. Also, as Armen mentioned, we very much value the opportunity to cooperate with such an important organization as UNDP, especially when it comes to the region of IKIS, because on the one hand, other markets already developed various instruments, and it took decades for them to develop these instruments. Now, we have a very interesting situation when new markets, like the market of the former Soviet Union and Central Europe, can study all those lessons which were learned by people in Latin America, by people in Africa, by people in Asia, so save quite a lot of time and quite a lot of efforts. However, due to general understanding of the importance of new financial instruments and the level at which these instruments have to be implemented, which is a sovereign level, any kind of cooperation, any kind of help from established international institutions is really vital, because whatever large or reputable private company be, it is not necessary that government of a former Soviet Union country or government of Central Europe will listen to them effectively. So thank you very much for such an opportunity of cooperation, and we think it will bring really good, fruitful results. As Armen mentioned, I'm Chief Executive Officer of Phoenix CRetro, which is Bermudian ILS specialist and focused on the region of Central Europe and former Soviet Union. 2 points I want to extrapolate. ILS stands for insurance-linked securities, which basically describe the whole area of convergence between traditional catastrophic reinsurance and capital market investors. I will speak about this a little bit later, but whenever I will be using the word ILS, it means the entire asset class comprising 4 different techniques of work. Bermudian, that is something which I have to say as any Bermudian company, and it's very important for us to bring this information to new parts of the world. Contrary to many other Caribbean islands, Bermuda is not an offshore destination. It is not an offshore by OECD classification. It is not an offshore by European Union classification. It is not an offshore by United States classification. This is the world-renowned center of catastrophic bonds and insurance-linked securities, and approximately 75% of all global transactions with catastrophe bonds coming through Bermuda. As such, also it plays a significant role in global catastrophic reinsurance, whereby Bermuda is the third largest global reinsurance center. And if you look into the list of 40 largest global reinsurance groups, 16 out of 40, they are Bermudian companies. And it is not because of tax position, it is because Bermuda consciously for approximately 60 years have been building framework, regulation and other rules and gained its recognition in the world of catastrophic reinsurance. So, as I mentioned, we are going to talk predominantly about catastrophe bonds, which is comprising, which is part of a larger definition called insurance-linked securities, usually consisting out of four different types of activity. First one is cat bonds itself. Second one is a work with indexes called industry loss warranties. Third one is collateralized retro, and last one is use of sidecars. That is where we are going mainly from pure investor point of view, where it is a cat bonds. Further down the line, when client understands what insurance and reinsurance is. For example, collateralized retro is a classical reinsurance with one interesting point which I will be giving on the next slide. Industry loss warranties is an index of an overall loss to the insurance industry. So it's not a loss for particular company, but a loss as such for the overall class of reinsurance. In any case, all these four techniques are used very much by those who want to enter catastrophic reinsurance as a class of investment. Because this class of investment, first of all, offer really stable and relatively high yield fixed income. And probably it is the only one asset class in the world which is totally, absolutely uncorrelated to general economic cycles. You will not find any other class of investment like that, because whatever happening in the global economy, fall of dollar, fall of price of oil, fall of gold, civil war, whatever, it is not touching the pricing of catastrophic bond at all. The only point which we concerned is global catastrophes, its size, its frequency, and its severity. So for asset managers, it works as an ideal diversifier within their already existing portfolio, because any asset manager is looking for diversification of their portfolio as much as possible, and catastrophic bonds as part of alternative investment allocations is an ideal diversifier within the portfolio as such. All four types of insurance-linked securities, they all have one thing in common, which is physical collateral. Whenever you're talking about a catastrophe bond, whenever you're talking about industry loss warranty, sidecars, or whatever, always the amount of liability exists in a physical way within a third party on the collateral trust account, so within a third independent party, and it always exists. That is why work with ILS so much cherished all over the world by clients, by those clients who technically can get a payment in case of disaster. Contrary to classical reinsurance, when reinsurance company is protecting their promise to pay by the balance sheet, whatever you work with ILS, it is always 100% physical cash existing somewhere. That is why the speed and effectiveness of payment in ILS always overcome the same way within classical reinsurance. And over here, actually, the whole world of those financial institutions who are providing collateral trust solutions. I mean, suddenly, when preparing this slide, I suddenly realized that probably it represents 95% of all those people who are working as collateral trustees. As you may see, there are quite well-known names, and what is very interesting is that Credit Suisse is not only collateral trust provider, but also second or third largest player for the funds management for placement within ILS and catastrophe bonds. Current situation on the market is that the overall number of issued and outstanding capital stands close to $40 billion, and you may see how issuance of catastrophe bonds from its very beginning, when the first catastrophe bond was issued by Hannover Re in 1997, there is a dynamics of the growth of this market. There are basically three major reasons for that. First one is availability of capital and wish of private market money investors to enter reinsurance as an investment class. So number of people who wants to step into this market growing over the years, despite some losses maybe a couple of years, but they still really like it. Second one is some general cycles within the reinsurance market, when after large disasters, predominantly it is American hurricanes, but classical reinsurers losing quite a lot of capital, plus the market rate is not so favorable for them. So clients are starting to look for alternative solutions for their reinsurance, and that is where capital markets investors, who are not professional reinsurers, but happy to take this risk, entering the market. Currently, so-called alternative capital, which is not professional reinsurers, but those people who are investing money into ILS, stands at about 20% of overall global reinsurance capacity, which is approximately 550 billion for this year, which is not, it's 1/5. So it is not a small amount, and it is a very serious argument which influencing current reinsurance policies and reinsurance strategies of almost every large insurance company in the world. On the next slide, you may see the number of transactions and cumulative versus cumulative amount of capital put into work. So as you may see, for the last year, we had approximately 65 new cat bonds issuances, while when it started, it was one or two per year. Also, with regards to geographical scope, current cat bonds market comprise the following cycle. There is one quite a big problem which exists, is that being very advanced instrument on the North American market, vast majority of more than a half is very much US exposed. Predominantly it is US hurricanes, floods and earthquakes, which actually creates a little bit of a problem, and also it creates a very positive situation for any new territory or any new peril. And that is why bringing any new geographical territory cherished extremely well by current investors who already allocated, because they are too much overheated by the United States. They've got too big US exposure, while they want to have intra-class diversification. So if they already allocated for catastrophe bonds, they will be seeking to get as much as possible different territories and different perils. So as you may see, predominantly it's United States, with another largest chunk, which is Japan. When we are talking about catastrophe bonds, we are talking about kind of a unique instrument which works much wider than classical insurance and reinsurance. The problem is that when serious disaster strikes, there are quite a lot of objects of critical infrastructure which simply physically cannot be insured. Dumps, bridges, roads, schools, all things like that. It is where state as a sovereign have responsibility to recover. So they cannot use classically the mechanism of insurance. I'm not now talking about even about development of the insurance market. It cannot be used by insurance by definition, because responsibility for these type of objects is something which is a core of a state to look after this type of objects. Interestingly enough, when Hurricane Sandy in 2014 struck United States, and it struck somewhere near New York, which is by definition the most financially advanced and developed territory in the world in terms of finance and in terms of insurance protection, it appeared to be that only 50% of losses appeared to be insured. The rest were uninsured because they were critical infrastructure objects. I see that Clive is laughing because it's one of his best examples he's always giving on the international conferences. So over here, and it's very interesting with regards to our region of Central and Eastern Europe and EKIS countries. Over here, you may see the aftermath of Northridge earthquake in California, which happens about 10-15 years ago, and quite recent last year floods in Mexico. Over here is with a railway. It is a railway terminal, and Northridge was not actually a large earthquake. I mean, technically it was only 6.7 magnitude, but you may see what's happening to critical infrastructure when it comes to railway thing. And the next one is Honda Motors plant in Mexico after floods of July last year. And as you may see, technically, you can get, in general, you can get insured your plant, you can get insured your business interruption, you can get insured your warehouse, but you will never ever have insurance for railways as such, for roads as such, for bridges as such. However, experiencing large losses, any sovereign will be looking for the instrument how to protect these type of losses and how to get reimbursement as soon as possible. And for this, from the capital market instruments, only one instrument which exists is a parametric catastrophic sovereign bonds solutions. Because parametric catastrophic bonds, they are working and triggered by particular parameter which is preset when bond is issued, irrespective of the amount of loss which actually happened. Which means that if I will give an example by slide a little bit further, but it means that you are getting payout where the parameter, if parameter is reached, and if it is within a parameter, the state is getting payout. And it doesn't matter how big was the loss, which basically resolves a fundamental question which exists within international organizations like United Nations and the global community looking after large losses. Because quite a lot of job is done for prevention of disasters. Obviously, quite a lot of job is done and quite a lot of involvement is done when disaster actually happened. So it is a relief stage. But somewhere in between, there is one very important, I would say, it's a domestic question. You had a large earthquake, you've got 30,000 people displaced, you need to feed them, you need to buy tents for them, you need to do it tomorrow, and in order to get international help, it's going to take you 2 months in the best condition. But you need some fast, reliable funds in order to start these processes. Basically, it touches a very important approach within any state, how to tackle and how to solve these questions and how to solve this situation. There is a risk layering approach, which is currently used by vast majority of the countries in the world, where it's divided into 4 different subclasses. All relates to severity and frequency of disasters as such. So on the local level, one of the solutions can be insurance. There are some insurance products which can be introduced. Insurance penetration can be stimulated somehow, but it can be decided on the level of insurance. The same way works for regional level, especially when it comes for some solutions with crop. When due to flood or rain or frost, you can lose quite a lot of crop, for example. And insurance companies, especially large insurance companies, currently working with different instruments based on the parametric indexes of whether temperature fall. The index can be whether temperature fall below some level or something else happens. But in general, it is insurance schemes. However, when it comes to national level, due to 2 major factors, one is, which I mentioned, that insurance cannot cover all expenses of the state, and second one, because insurance penetration is far below normal, especially when it comes to the territory of Central Europe and former Soviet Union. So basically, the instrument which can be used is catastrophe bonds. There are another 2 ways of relieving this, but I will be touching it on the next slide. Also, there is a sub-country, multinational level. Unfortunately, it doesn't work for our region because our region is too much fragmented geographically, politically, perceptionally. But there are examples like Caribbean scheme for Caribbean islands, which is now extended to Latin America, where all Caribbean islands get together, created a facility called CREF, and CREF buying on behalf of the pool of states, buying a protection from hurricanes, for example, or from earthquakes, for example. The same situation exists in Africa. In Africa, it is not for disasters, but it's more for pandemic cover. But they've got African Union, which is a very strong organization and very strongly promoting solution at the pan-country level, so they can easily govern this and they can easily buy this type of protection for several countries at once. Over here, that's what I mentioned. I will be telling. You've got basically 3 major phases after disaster happens. One is relief, then it comes to recovery, and then it comes to reconstruction. So, if you remember the previous chart with regards of multi-layering approach, on the very bottom level, usually you can the country can use national reserves. Unfortunately, vast majority of countries, I don't know how it works in Central Europe, I know that in former Soviet Union, countries do not account for any reserve for disasters. So it always comes as a sudden situation, and they suddenly need to find it in a budget. But for relatively small events, it is possible to find some funds for the sovereign in order to start at least a relief page. On the medium size of the disaster, usually the country trying to first of all recalculate and reallocate its budget, think of how they're gonna take the money further by tax increases, by other ways of taking money from the public. Also, that is where sometimes countries try to work with external credit. They can either try to get credit from financial institutions existing in their country, or they may try to attract private money from international investors. Which is, again, this is a theory. In practice, presuming that sovereign rating of former Soviet Union countries is very low, in Central European countries at the medium level, it makes this money really expensive for Central Europe and close to impossible for former Soviet Union. But both two ways, it is when the government is retaining risk as such. However, for really large disasters, there must be some instrument for transferring the risk out of the country. And in order to transfer this risk, basically there are only three ways existing all in the world. First one is donor nations help, which is a purely political situation, and I see that you represent different countries, and you understand that if, for example, if you are Montenegro, Germany may like you, they will give you larger help. They may not like you, they will not give you larger help. So it's purely internal political situation. Another one is use of international financial institutions, and the most well-known institution for that will be the World Bank. World Bank have an instrument which is called Catastrophe Deferred Drawdown Option, which is basically a credit. It's a credit line. It works like when this system arranged, and after disaster, as a state, you may take whatever pre-agreed amount of money for your relief stage to finance your immediate needs. And then it's automatically converted into a loan. However, let me reiterate one more time. It is a low interest, it is long, let's say for 30 years, but this is a loan from international financial institution. Now, try to imagine what happens to you as economy if you already have a junk investment rating, investment grade rating. Getting such a burden on your sovereign debt will send your rating down to nowhere. Also, there is a geopolitical issue, because everybody knows that the World Bank, in some circumstances, trying to influence internal fiscal policy of the states. And if we are talking about former Soviet Union countries, unfortunately, it's not that I personally approve this, but unfortunately, reality is that we've got China nearby and we've got Russia nearby. And if something happens, and Russia will not like Uzbekistan to get a loan from the World Bank, Uzbekistan will not get a loan from the World Bank. That's a reality, unfortunately. So why not to use a third existing instrument, which is a transfer of sovereign risk into capital markets, whereby investors have absolutely no political interest or political connection. The only point they're interested, as I mentioned to you, in this asset class is because A, it is relatively good return, it is better return which they can get from other asset classes, and B, it is totally uncorrelated to general economic trends, so it is really healthy for portfolio diversification. And C, if something happens, nobody there to be blamed. It's investors' risk, and if there is an earthquake and if catastrophe bond defaulted, nobody owes nothing morally to anybody. It's a classical it's a classical default of a cat bond. And contrary to, for example, sovereign bond, where country borrowing money, default of such a bond can bring reputational issues. With catastrophic bond, it never brings reputational issues, because you're actually buying this to get protection from devastating disaster. So that is why cat bond seems to be the best option for our region. I'm not saying that for any region on the globe, but for the region of the former Soviet Union and Central Europe, it seems to be the best fitting option. Also, just touching one question a little bit, which I mentioned a little bit earlier. When we are talking about use of insurance, unfortunately, for the region, insurance don't play any role. I'm not even saying significant. It is not playing absolutely any role. And there is one misperception of the general situation, because when there are global analysis of what insurance is for different territories, there is a classical example how insurance world and how analytics dividing the globe. The green one is those losses which uninsured. The blue one is losses which get covered by insurance. As you may see, the best situation obviously in North America, although you will be very surprised that in California, very earthquake prone territory, less than 10% of people buying household earthquake insurance. But still, it's almost 50% of losses get covered by insurance. But when we are looking into our region, which is technically referred to Asia in this schedule, you are having a figure of 9%. And it is not a bad result. However, situation with our region is much worse, because in that drawing you've got all territory of Eurasia. So technically you get included countries like Japan, with one of the largest insurance penetration in the world. So this figure may represent the overall figure for the territory from Berlin to Tokyo. It is a nice figure, but we are talking about our region of IKIS and of Central Europe. And unfortunately, with us, situation is completely different. That is how situation stands with insurance penetration. As you may see, it is a fraction of 2%, with only Turkey managed to overcome 2% of penetration, with other countries not having insurance anyhow serious on the macroeconomical level. So this is a very important question to get addressed when thinking about potential of disaster relief, especially for international organizations, and especially when you are looking for the question of disaster risk resilience from the angle from which United Nations is looking into this, because I totally understand United Nations is interested for the overall picture of disaster relief, while we are talking only about a small fraction of this, which is a commercial part, which is insurance. So for any Ministry of Finance and for international organizations, unfortunately, insurance for 30 years of independent market did not develop into any significant or any serious way as an instrument. Also, there are some local peculiarities in several countries of the region. There are a little bit strange perception of international cooperation and measures like, for example, protectionism, local protectionism. They are not allowing local insurance companies to get a transfer of know-how, not to get the understanding of how to protect and how to develop different products. I can give you a very good example. Just yesterday, I was attending Belt and Road Forum in Belarus, and there were local insurance company, the largest state insurance company, representing insurance as a sector for Chinese investors. I came to their stand and I said to them, okay, let's say I'm a Chinese guy who is building 300 million plant nearby. How will you get it covered? And we are talking about largest insurance companies. They said, you are getting insurance policy, and what happens to reinsurance we don't know, because all reinsurance is on a compulsory basis done via state operator, and we are not in the control of this. I said, sorry guys, your own retention is 60 million euro. 240 million euro must be protected by reinsurance. I am coming to you as an insurance company, as you representing insurance on the forum, and you are saying to me that you are not in the control of this and you can't do anything with it. So unfortunately, creation of such barriers as a local unnecessary intermediaries also do not play well for the development of insurance market as such. Because in those countries who have a good direct access to international markets, they all cooperate with well-known reinsurers like Munich Re, like Swiss Re, like Hanover Re. They all have day-to-day liaison and communication. They all getting lots of knowledge, lots of understanding, and basically developing the means of insurance and reinsurance much faster than anybody, than those countries who are not in, than those countries who are having private, who are having state intermediaries. Also, there is one other very important question when it comes to regional cooperation and regional infrastructural projects. Probably one of the best example would be Chinese Belt and Road Initiative. Obviously, it may have different connotation from different countries, but for sure it's the largest infrastructural project in human history at the moment. It counted in trillions. It takes almost 100 countries in the world. Whatever we all think about this, nevertheless, technically it's the largest infrastructural project. And a very good example, just to give you a very good example, when key corridor leaving China, it goes into Uzbekistan, or into Kazakhstan, and then from Kazakhstan divides into 3 sub-routes. Moreover, on the border of Kazakhstan and China in Almaty region, they are thinking, and they already built, they already developing it, the largest dry port in the world. Now, for those who ever touched the question of seismology, this region, it is one of the most, if not the most, earthquake exposed territory in the world. Especially when it comes to Almaty region, for large earthquake, the question of if never exists. It's only a question of when and how big. Moreover, last century had examples of a really devastating earthquakes. I can give you only 2 examples which everybody knows. In 1966, 80% of Tashkent, 80% of Tashkent, were demolished within 40 seconds. And obviously everybody knows about 1988 Spitak earthquake, when 1/3 of the country were demolished within 1 minute. And situation is that economical effect of this were able to overcome because of the existence of Soviet Union. Because 40% of national production of Armenia as a country were absolutely shut down. And as far as I understand, it's not recovered yet fully. So if Armenia would exist at that time as a separate country, it would have meant the end of the country, the end of the economy. With Tashkent, you've got the capital of the country, and you may imagine what means 80% of the capital being totally demolished. In Soviet times, they would build another capital nearby rather than doing relief for such a big earthquake. And now we are having such a situation with infrastructural projects where China pumping billions or even tens of billions into railways, into roads, into dry ports, into warehouses, and this is investment. So when situation, really big disaster would happen, the state, considering that those states in Central Asia, they are relatively poor states, they will need to save their own population. They will not have too much in mind what would happen to those investments of somebody else. Moreover, considering that it's a key transport corridor, it's not only potential demolition of a small area. It is a potential that whole Belt and Road project will stop for another half a year or a year, which will be required in order to recover this type of activity. And over here, you may see this is all official information from different risk managers, but over here you may see proximity of severe, really severe, more than 7 degrees magnitude earthquake within the next 50 years. This is in northwest China. That is actually that is where that is where Belt and Road leaves China and goes into Almaty. There is Kazakhstan. All Southeast Asia is earthquake prone. This is Kyrgyzstan, which is absolutely, as a whole territory, earthquake prone. This is Tajikistan with the same situation, and this is Uzbekistan. And Tashkent is over here. And through Tashkent, it's another large Belt and Road corridor. So, question of protection of infrastructural projects, i.e. use of instrument which is much wider than insurance, like catastrophe bonds, is not only in the interest of participating states, but also in the interest of much wider strategical pushers or strategical investors like China, who are trying to develop this project as a project. Again, I'm not putting any good or bad comments about project as such, but still, there is a really big interest. As I mentioned, also within the world, there are several solutions which already existed, and several governments and several pan-governmental schemes which came to different type of solutions. Somewhere it's done by particular state, somewhere it's done by pool of countries, somewhere, like in the United States. United States is a very fragmented country. They do not have single governing body. So in the United States you've got separate Florida, separate California, and they are buying their solutions on the level of the state. Like earthquake, California Earthquake Commission buys their protection. Florida, as a state of Florida, buys their hurricane protection. But over here is just a list of how differently various countries and various partners came to the question, all of which represent different way of the solution for the really big disaster. We will have this presentation somewhere either on our site or with the university. I mean, somehow we'll have a way to make it public. So just have it as a list of reference. Now, when I mentioned to you how catastrophe bond is working, this is the most point which we want to deliver, because we understand we are doing this on a day-to-day basis, and we may understand that talking to those who are not in this business may be difficult. However, the key message I want to deliver is that cat bonds is not a rocket science. It's a very, very, very simple solution. Oh. Sorry. Yeah. So, you've got first of all, you need to have those who are actually issuing this. From what I said before, and considering the general interest, it must be either state as such, or some authorized agent of a state. In some circumstances, it can be Ministry of Finance, like in the former Soviet Union countries, Ministry of Finance issuing borrowing bonds, like Eurobonds. But when it comes to disaster relief, several countries, they've got special funds. Like, for example, in Mexico, they've got a special state fund for disaster relief. It's called Agrosamex Fonden. It's known as a Fonden, which is actually the largest issue of earthquake cat bonds on the sovereign level. It's not only largest, but also the oldest one. Then you've got capital market investors, which is predominantly pension funds or professional asset managers. Very simple. Bond is issued and it's traded over the counter through, it's traded like any other bond. You may buy Apple, you may buy Hungarian currency bond, you may buy Catastrophe bond. There is no difference at all. For which the state is paying coupon. Coupon is actually calculated as per particular formula, and very thankful for one of my colleagues, Despoina, who is a very big specialist on this in the London School of Economics. She will be telling us how actually pricing of a cat bond is created. So I'm just mentioning it as we decided, but leaving it later for you. Then that's what I mentioned. You've got a third party in the form of a collateral trust. So whatever amount of bonds you're issuing, let's say you're getting a protection for 200 million for Budapest for flood. This means that 200 million physically is given to Credit Suisse, sitting there physically, ready to get paid any moment, and Credit Suisse have a very, very clear instructions, predetermined instructions, when this money can be released to the party. The best example would be an example how Mexican cat bond is constructed. This is a live example. It's not philosophical. This is a live one. That is how Mexican government decided to protect themselves from earthquake. I'm not saying that any other bond can be in the same way, but that is how they calculated it. And there are special people called modelers who are modeling the potential loss, and the decision is based on these models. However, that's a general hypothetical example. If you've got 7.9 magnitude, all 200 million on your account within 1 working week. Over here, again, as I said to you, that's when Mexican government calculated economical factor of the stuff. But that's a live example how they constructed earthquake protection for Mexico. So technically speaking, the only point which needs to be proved is the actual size, the actual magnitude of the earthquake, which is basically done on 2 levels. First one is national level, when National Academy of Science or emergency, whoever is looking after seismological stuff. And then it should be proved by any independent source. In many circumstances, for Mexico it's definitely United States Geological Service. For Europe it also can be USGS, but Europe has its own system. Anyway, it needs to be a third-party independent proof. Once situation is proved, Credit Suisse already knows, and the only point Credit Suisse looks whether this parameter works or not, because they are really independent, and independence of the collateral trustee is one of the core elements of this type of business. Just not to give too much philosophical issues, here is live examples of live cat bonds being issued over last 10 years, 11, 15 years. As you may see, one of the largest, as I mentioned to you, one of the largest buyers and oldest buyers is Mexico. And on the next slide you will be very much surprised how good Mexico is in issuing cat bonds. But they've done it for hurricanes, they've done it for earthquakes. 2014, Clive, that's what I mentioned about Latin American countries, and it was arranged by the World Bank. One of a very pleasant situation is Turkey, the only country in the subject region, which is our region we're all talking about. With the help of American brokers, they were able to issue 2 tranches of catastrophic bond for the protection of Istanbul area from large earthquake. And actually they not only issued these bonds, but they also implemented some way of how to get it paid by the population. I'm not sure whether I'm right, but maybe Armen can add it up. But I think that somehow Turkish people contributing $1 or $2 to this type of coverage, so they can buy it. I just don't know how it's on the domestic level. As I mentioned to you, a year ago, in addition to Caribbean countries, the World Bank also gained Latin America, and Latin America is now also properly covered. And 2014 is just a big noise on the market. FEMA is United States flood scheme. That's what actually started after Hurricane Harvey in Texas, and at last it comes to some form of a solution. And now, something which says more than words. That's a situation of the money, what Armen actually mentioned. And if you may see, within lifespan of a cat bond, lifespan is 3 years, within a lifespan of one cat bond, Mexico, having issued these cat bonds, had 50 million paid out and 150 million paid out. One from Chiapo earthquake and one from Hurricane Patricia. So, if to put it into a very simple language, they've spent approximately $2 million and within a year got $200 million paid out. Nice business. Everybody happy, everybody clear, nobody is offended, everybody understood how it works, but there is a proof that concept is working. So we are not trying to represent theoretical issue, but there is live situation how this works. Another cat bonds.
Excuse me. Can I ask a question?
Yep.
Is there a limit to that 200 million?
Usually, you define. I mean, first of all, issuers of cat bonds, it's either governments or insurance companies, advanced insurance companies in the States. When you are talking about government sovereign bonds, which is the subject matter of our seminar, is you calculate with the help of third-party assistance or by yourself, you calculate what is your critical amount of money you really need tomorrow if something happens. In theory, you can issue whatever cat bond. I mean, Latin America cat bond is now 1.6 billion, I guess, for 3 countries or for 4 countries. But as a Minister of Finance, together with the Minister of Emergency, you are sitting and thinking, if tomorrow I have 7 degrees magnitude in my town, how much money would I need in order to act fast? Obviously, you get your help, but afterwards. You get your help from your friendly country in half a year. You get your help from international institution in 3 months. But how much money you need tomorrow in order to feed your 20,000 people, in order to buy them shelters, in order to buy them stuff. So it's always a balance between the price you are paying, the coupon, and the money you may need for the relief phase. Also, as I mentioned, it's not only sovereign, it's not sovereigns. The key issuers of cat bonds is large insurance companies who are using them as an alternative to classical reinsurance because in some circumstances it can be even cheaper than buying classical reinsurance protection. Now, very important question and very important bit to explain is why people are buying and why people are investing into catastrophic bond. And I would like you to put yourself in the place of a money market manager, as an asset manager who needs to deliver a good result, a good return, and this return must be as small risky as possible, as stable as possible, and preferably diversified in different types of activities, being not correlated. The correlation is very important point for investors in any part of the world. That's a very good quote from the Wall Street Journal, which exactly represents the concerns of private money market investors. They need to keep the level of their interest low. They can't rely on classical instrument anymore with current situation, so they're constantly looking for some form of diversification. And there is a list of those investors who already allocated more than 100 million for investments into cat bonds. Actually, there are some really big leaders who use much larger amounts, who allocated much larger amounts into this type of activity. As you may see, some people is doing more than 1 billion. There is one point which is now much larger. It's a little bit. It's a last year schedule. This year, Ontario Teachers Pension Fund, which is one of the largest players in the ILS field, they already allocated in billions for investments into insurance-linked securities, and they consider it as a very good success story for them. They're very happy for the stuff. So as you may see, all sorts of pension funds really enjoy investing into ILS. PGGM, AP2, AP3, it's a national sovereign funds of Nordic countries, like Norway, like Denmark. I don't know whether you've heard or not, but these are guys who are having the largest chunks of money in the world. Norway fund is more than $1 trillion sovereign fund. So just to illustrate why ILS is so cherished by international investors. This graphic may be not a good one because it ends by 2016 and we had 2017 and 2018 year of losses, but still in a longer perspective, when we are talking about 10 plus years, 15 years, you may see what happened to all sorts of key asset classes all over the world. Whatever you do, whether there are commodities, whether there are corporate bonds, whether equities, other stuff, the most stable trend is cat bonds, which is totally, absolutely uncorrelated to what happens in the global economy. And you may see that throughout that period, there were lots of different financial crises predominantly, which absolutely not giving any sort of impact to the development of an asset class as cat bonds. The only point which impacted a little bit is when there were some significant disasters, very well known, like Katrina hurricane, like Tohoku, which is Fukushima earthquake, like Sandy, and so on and so forth. That is for you to explain how the mindset of asset manager is working. As you may see, vast majority, and again, it is an example of two life pension schemes, not large, really large pension schemes, they are counted in billions. These are quite small guys. One is from Germany, I think Linde is something to do with metal. And Centrica is one of the energy suppliers in the UK, again, not of a big size. So that is how their portfolio of investment actually is constructed. Obviously, there are assets, there are equities, they also play on some emerging markets, they also play on some property, but each of them allocated not less than 3% for Centrica and 4% for Linde for, they call it Catastrophe Reinsurance, which is technically means catastrophe bonds, and sometimes when they are working with management companies, like ours for example, when I've got an investor, I'm not only offering them catastrophe bonds, but we also offering them to enter sometime for a small chunks reinsurance market. You can go into the program of Hanover Re, you can go into the program of Swiss Re. It will be riskier business, but much more rewarding. Obviously, it's a very small allocation, but for overall portfolio, it makes a figure is much better. Again, it's a question of trust between investor and their professional manager, and it has very much to do with insurance experience. But this, any ILS investor is investing not only into the cat bonds, but also into industry loss warranties, into collateralized reinsurance, and so on and so forth. Also, there is much better example, as I mentioned to you last year, where really big loss and really big hit by Harvey, Irma and Maria hurricanes in the United States. Over here, actually there are 5 largest events brought losses counted in hundreds of billions for the insurance industry. But this is an overall index which is calculated by Swiss Re, comprising all sorts of cat bonds which are traded on the market. And as you may see, the largest events like Katrina, like Tohoku, like Sandy, which hit New York very much, and like really devastating series of events last year, the index as such very rapidly recover itself, because number of those investors who are investing into ILS always bigger than the number of those who are thinking of leaving it, because they do understand. We are especially when it comes to large earthquake. These are events which are happening once in 100 years, once in 250 years. So everybody just thinking, if we had 8 degrees magnitude earthquake on that territory, the next one will happen not tomorrow. So that's general basic understanding. Another very interesting example is the Lehman Brothers collapse. There is the only lesson and why ILS market appeared to be so stable and why we started to use only real physical cash. This loss happened because at that point, couple of collateralization contracts were written by derivatives. So not by physical cash, but there were guarantees or letters of credit by Lehman Brothers as a financial institution. And obviously when Lehman Brothers collapsed, those collateral disappeared. And that is, after that point, ILS industry decided that we work only for cash. No derivatives, no guarantees, nothing, only cash. Cash is the king. So we do know how to learn lessons. There is another argument which I mentioned before, whereby investor already decided to allocate for alternatives, and within alternatives they've decided to allocate for insurance-linked securities. That what you can see what's happening to your overall general portfolio. You've got 3 types of strategies, 3 types of portfolios. One is when you've got bigger amount of bonds. Another one is when you've got 50-50, and another one is when you're actually equity denominated, when you're investing into equity of several companies. So the black one is parameter, a standard parameter, overall parameter average for that type of investment. And then what happens if you add into your portfolio 15% of ILS investments? As you may see, all sorts of parameters from return to volatility and even to performance of a really risky business, it makes your portfolio healthier. So for money market investors, investing in ILS is a really good way of making their portfolio healthier. Also, that's from investors' point of view. From the sovereign point of view, there is an instrument whereby all you need is to understand how this works, step into issuance of sovereign cat bonds, and you have your economy and macroeconomy totally protected in case of real devastating earthquake, which is fundamentally important for the territory of former Soviet Union, Central Asia, and Central Europe, because unfortunately it's not very rich countries, and only few of them, if any, have a separate allocation in their budget for the disaster. And disasters, unfortunately, are happening in our territory. And it's not so far away. Even sitting here in Budapest, you may think that Tashkent is far away. No, you had Western Balkans, when you had 5% of Serbian GDP wiped out by flood, or their neighbors. So it's happening here, and it may happen anywhere. There is, just as an example, the largest ILS fund managers who are working from the end of 90s, and that is how funds under management actually appeared for the last 18 years. We had some large mergers and acquisitions on the market, and the picture on the market now a little bit different. However, there are some usual suspects like Nefila, like Leadenhall, who constantly grown their presence from 100 million. I remember, I have a very big friend, the founder of Leadenhall. I remember very well when he started 8 years ago from $100 million under management. Now he has 6 billion. That is why we really thankful and very much enjoying our cooperation with United Nations Development Programs, Istanbul Hub, and that is why we started the endeavor of introduction of sovereign cat bonds for the territories of IKIS region. We started in October last year with a large seminar for 18 governments, which was supported by international organizations as well as all our industry colleagues, so supported and endorsed. Now it went further down the line to a sub-regional event for Western Balkans. Then it came to a joint introduction of our partnership at the Global Platform for Disaster Risk Reduction in Geneva. And we really hope and enjoy that all together with ability and weight of UNDP, and with our knowledge of peculiarities of the market and practical information, we will be able to launch the instrument of cat bonds for the region and save lots of money and time, because we all can learn those lessons which Caribbean countries done for 10 years. And thank you very much. I will leave, at the moment, I will pass the floor to my very good colleagues, Clive and Despoina. Clive is a prominent, very well established specialist in ILS on the legal type. He has decades and decades of experience of work, especially in ILS. Moreover, he was named by Insurance Day as one of 50 most influential people in insurance worldwide, being the only lawyer in that category. And Despoina is a very well scientifically prepared and scientifically researching member of London School of Economics, learning very important bit of how pricing of catastrophe bond is created, which is extremely important. And whatever she says is not only important for some different parts of the chain, it's important for everybody, because it's important for issuers to understand why you're offering such a coupon, and it is important for investor to understand why they are paying this price for the catastrophe bond. So, dear colleagues, the floor is yours. Yeah.
Could I have a question?
Yeah, sure.
Are these only natural disaster related, or can they be issued for conflict as well?
Usually, for the moment, it's natural disaster and some pandemia, in Africa, some diseases. In theory, at the moment, there are some talks for the coverage for terrorism risk.
There was a map where you showed different countries and the percentages in green and blue, you remember?
Yeah.
asking, does India subscribe to cat bonds?
No, India I mean, it's very interesting that you asked because we're involved in some conversation with the government. After May, there was a large hurricane in May.
Yeah.
Yeah. After that, they've started to think for implementation of the cat bonds. The government is thinking about this. I think it's going to take quite a lot of time for federal government, and I think that it's much better if any particular state will start to do this. But the question is raised. They are aware about existence of cat bonds, and they are very much thinking about this. You may look into our dedicated page. We even wrote a couple of articles with regards to Indian cat bonds, introduction of Indian cat bonds. But yes, some of Indian states are thinking seriously about cat bonds. Ladies first.
You showed a slide about how insured are different countries, and I saw Tajikistan being as the lowest one, and I'm currently living in Tajikistan, and I'm wondering, do they have this small tiny part, is it the insurance of the hydropower plants or of the flood caused by the earthquake, for example, or?
Unfortunately, we don't have statistics for particular perils, but as far as we know, insurance in Tajikistan is very, very underdeveloped. I think
Billions in hydropower plants right now.
I would think that probably those which are insured would be investors who are digging gold or foreign investors who are insuring their assets. But Tajikistan has one of the worst situations with regards to insurance.
I have just three questions. One is related with you said that the international investor will invest in this bond, and then how they charge to the countries for those to invest after when they put the money from debt or when the country consume, then they apply, and how they get back.
That is a very interesting question, and thank you very much. Contrary to other types of disaster finance, believe me, I'm telling you from practice, investors have absolutely no political connection. The only point they will be looking is how much the new country diversifying their exposure. For example, if you are having 60% of your exposure on Japan for earthquake, further down from Japan, better they will be looking for this type of investment. And they will not even think which particular country it is. Most important for them is geographical diversification, which is done more by geographical region rather than country as such.
And they charge when they put some they invest, or they charge when it has happened and the country has consumed. So they charge after the consumption or before the consumption. They can also charge.
What do you mean charge?
Means because they invest means they get back or what? What is the meaning of investment?
Well, they are buying a cat bond.
Yeah.
They are putting the money onto the collateral trust, which is independent. If nothing happens, they are getting paid a coupon within 3 years. Nothing happens, they got all the money back.
Same amount.
No, more. Of course, more.
No, you've got the amount of collateral, 100 million, and then you've got, let's say, 3% per annum coupon. While your 100 million sitting on the collateral trust, you are getting 3% every year. If nothing happens, you got your 100 million back.
And who paid this 3%?
Government, the issuer.
The insurer. Okay.
It's called, technically they called sponsor. Those who are issuing called sponsor.
And let's suppose that the example of Mexico, you said that they have invested 200 million. If they don't consume in time of 3 years, then what happened to that money?
That money would be returned to investors.
If they invested by self, the country invests by self, then
There is no logical sense for country to invest itself because we are talking about transfer of sovereign risk. Well, in theory you can, but it's too difficult. It's better to make your own allocation within a budget without any bonds issuance. Just make a side pocket for the earthquake.
Rainy day.
Last one.
Oh, sorry. Yeah.
Okay, yeah. The other thing that you said that it's important to the physical presence of money, the cash. Where, which location, and how you manage it, the physical. Let's suppose you are in Mexico, you are in Pakistan.
It must be well-reputed organization who is specializing, who understands peculiarities of insurance. And as I gave you in the very beginning, it's only 6, 7, 10 banks who are providing these type of services. The key point for them is total independence, and that they both agreed by the government, by the sponsor, and by the investor. So you as a government must be happy where you keep your money, and investor must be happy where he keeps his money. He can't keep money in your country, you can't keep money in some enemy country. So you all together, you are sitting and you are thinking, oh, let's go for Geneva, let's go for Credit Suisse. Switzerland is absolutely in between. Or you are American, you are saying, I'm fine with Citibank, because we know Citibank. Yeah.
My question is related on how the market of this type of bonds is adapting, for example, for changing situations such as climate change. I understand these are more products for low frequency, high intensity type of disasters, but if we're talking to a region of the globe that will be more impacted in the future by certain type of disasters, if this market is adapting to it in terms of pricing.
First of all, in terms of climate change, these type of investments is cherished and considered by everybody as a green investment, which is within the framework of what the globe is doing. Second one is the overall trend is getting from a really large earthquake down the line to communities like parametric solutions for local communities, for crop insurance, for some other type of coverage. Sometimes is required, sometimes is needed, but ideally any area within the country can issue their own bond for protection on the climate change.
But then the maturity period is normally 3 years.
Usually cat bonds is for 3 years.
But then if you have a more frequency of events, it becomes less profitable and more risky to invest on this type of things, no?
Well, 3 years is an ideal medium between 1 year, which is too short, and 5 years, which is too long. So it's a medium market practice, I would say.
I'm trying to think on the side of the investor on how it gets affected by the fact that it becomes more risky, tends to become more risky if you have this other.
Yes, but in overall 3 years is a short investment. It's considered to be a short investment. So probably they like it not only for the way it's uncorrelated, but also for the way that it's quite a short investment. So you always have time capped by 3 years. And you may see what happens after 3 years, you may buy another one.
Can I say something? If I understand correctly, climate change events can be many, like the disasters. Now, let's say if I have bought the cat bond for one event, the other event which might happen and this might have not happened, in that scenario I will not get any money.
No, but you can buy multi-peril bonds.
Yeah. So that is where they make money, the investors, because let's say Japan might have a cat bond for earthquake, but then they had flooding, and even though the damages were a whole lot, but then they could not get any money.
It's all for your money, my dear.
Yeah.
If you are a state, pay us more, we'll give you more perils.
I didn't understand one thing. How so the investor is deciding, like for example, the Mexico, yes, like below 7% earthquake, they are not gonna get anything, but after above 7%, they are getting the tranches. But how do you put this limit? Is there any evaluation which is a catastrophic one?
You as a, I mentioned it, you as a
So
Minister of Finance, sitting together with your treasurer, sitting together with your Minister of Emergency Situation, and you think which size of event can be really painful for you, for your budget.
Okay.
It's like, as a Minister of Finance, you may say, well, okay, if something happens, I may find 200 million. But what if 300 million is required? So in that case, 200 million can be found internally, and for 100 million you issue bonds. So it's internal question, internal evaluation, and there are colleagues of us who are helping to do so, called modelers.
Maybe I don't understand something, but you mentioned in the beginning that catastrophic bonds, they don't depend on other factors apart from disasters. But if you have cash in a depository, what if like the currency falls? Doesn't it depend somehow on that?
Those currency which is held on the collateral trust, it is not belongs to anybody. It's within a third party. It is not invested. It physically sits there.
Yeah, but if it collapses, that kind of currency, or in which currency the investments are made?
Usually it's cash or cash equivalents, which is US Treasury bonds. Or physical cash. Well, obviously, if you got devaluation of the currency, if we got devaluation of US dollar, it's the end of the world. So we are back to feudal times. Okay, so let me give the floor to my colleagues because they've got really interesting information, and it is very important what they will be saying, one from legal point of view and one from scientific pricing point of view. Guys, please.
Thanks very much, Kirill. Good afternoon, everybody, and thanks very much for having us speak to you. I'm afraid that after Kirill's illuminating and energetic presentation to you, you're now stuck with hearing a lawyer speak for 15 minutes about legal issues, which isn't necessarily the most edifying thing, but legal issues go right to the core of this, and they are things that you need to consider throughout. Now, the first question that people ask quite often is, why on earth aren't we doing this through an insurance solution? Why do we need ILS at all? The answer to that has been partially answered by Kirill already. There isn't enough insurance out there. The other side to it is that there are two key elements to insurance that are important to keep in mind. An insurance contract requires insurable interest. And that means that if the government is looking to provide a solution, the government can only insure what the government owns. And if, for example, an earthquake happens and causes devastating loss to private property which is uninsured, the government couldn't, in those circumstances, have insured it for itself. And if the government wants to step in, wants to preserve the economy of the region by putting money into that, they couldn't have insured against it. To buy an insurance contract, you have to have an interest in the subject matter of the insurance. That is a key element of insurance. The second thing is, when you buy insurance, you have to prove your loss. And that takes time. To prove a loss after a catastrophe can take months, it can take years, particularly when you put in things like interruption of business and other things like that. It can take a very long time indeed to prove loss. So the insurance gap, delay, and generally a lack of flexibility make insurance an unattractive prospect. And the solution lies in catastrophe bonds, because catastrophe bonds respond immediately. A government doesn't need to have an insurable interest, it can just buy a bond without any interest at all. And therefore, it can buy something that will pay the moment the disaster occurs. And again, as Kirill said, that means that they can put the money into buying tents to house people immediately, or they can put the money into longer term projects to restore the economy of the region and to make it more resilient to the damage that has occurred and against the perils that might occur into the future. Cat bonds started out as a way in which to protect insurers against massive losses. And they are very highly thought of by insurance regulators because they are collateralized and they come from diverse sources of security. And therefore, if the insurance and reinsurance industries are being badly hit, catastrophe bonds come from elsewhere and are fully collateralized. What we've seen in the last few years, again, as Kirill pointed out, is now catastrophe bonds have gone broader than just providing protection to insurers. They're also providing protection to governments. They're providing protection to companies. And it's governments that we are most concerned with today. Now, what is a catastrophe bond? Well, here's a very nice graphic showing what a catastrophe bond is. And I can hear a sigh going across the room as everyone says, oh my goodness me, what does that mean? The great thing about catastrophe bonds is that they're not actually that complicated. Even a humble reinsurance lawyer like myself can understand them very easily and explain them quite simply, which is not necessarily what one can do with certain reinsurance contracts that get developed. Put very simply, all a catastrophe bond is a mechanism for holding money pending an event. Now, if we're talking about an event, I don't know, whether it's going to rain this afternoon, say you want protection in case it's going to rain this afternoon, we here in London are willing to give you that protection. Well, you could just, as you would with an insurer, wait for the rain to come and then turn to us and say, pay up now. Or, better still, you have us hand Kirill the money, and Kirill will just pay it out automatically if rain starts to fall. And that's what a cat bond is. Instead of Kirill, we have a special purpose vehicle, a very objective vehicle sitting there in the middle that is formed to hold the money that the investors put into it. The money sits there, invested in a period, and if the event occurs, it is paid out automatically. The investors have no involvement in the paying out whatsoever. And of course, if there's no event in the period, the money is returned to the investors with the investment income that's been generated on it and the premiums as well. So that sum of money is basically sitting there in a collateral account with an automatic payment, fully collateralized automatic payments. Those are the exciting things about it. Now the SPV, just one thing I should touch upon very, very briefly, because it does confuse and confound some people sometimes, but actually it's not that much of an issue, is that sometimes we have what are called protected cell or protected cell captives that are used for instead of the SPV. And these are very simple mechanisms where that big blue bar across the top is the captive. There are cells coming down from within it. And what you do is you already have the PCC established. It's regulated. The regulator are raring to go with it. And as you create a product, you hire one of the protected cells within it. And that protected cell then will pay out as and when an event occurs. It's a quick, cheap, and efficient way of getting a cat bond up and running. It's no rocket science and nothing like that. And the point here is that if one cell goes bust, it doesn't affect the other cells. The reason for raising that is that one of the issues that one has to look at when establishing a cat bond from a legal perspective is jurisdiction. Where do you set it up? And what you have to look for is to make sure that there is the regulatory framework in place. The regulator who's looking at this has sufficient reputation, that the structures, things like protected cell companies, are available, that the regulator can be swift and agile. Here, for example, in Bermuda, you can establish a protected cell captive within 2 weeks, which is pretty quick. In London, it takes about 6 weeks. Anything longer than that, and you haven't got the required agility, the required speed. Fiscal regime is important. Here in London, we've recently established a mechanism for this. There is no corporation tax payable on the protected cell, and therefore any profit is only paid by the investor, not by this mechanism. And therefore it means that there is no tax and no drain on the amount of money that's available to pay claims or to be returned to investors, which is an important thing. The legal regime is important as well. As I said, automatic payment is absolutely key to this. The legal regime has to be robust enough to ensure that that occurs, and it has to be predictable enough, and it has to enable enforceability of performance. Jurisdictions are Bermuda, which currently hold the lion's share of protected cell companies for cat bonds. Those are primarily insurance company cat bonds. Another jurisdiction is the Cayman Islands. The Gibraltar has a few, as do places like Guernsey and other small tax havens like jurisdictions. Of more substantial countries, and it's understandable that with sovereign risk, someone might want to avoid the Cayman Islands or other smaller jurisdictions which are seen as tax havens. Ireland does protected cell captives and can do cat bonds. Singapore has recently come into the game, and with Singapore, although there are some drawbacks to Singapore's regime, it also has the benefit that for a limited time only, they're offering cat bonds. The legal fees and other creational costs of cat bonds will be paid by the Singaporean Monetary Authority, which is an inducement, and the UK has very recently established the regime to do cat bonds, and a number of London market cat bonds have gone through here. Now, there is also, I suppose, the possibility of having a local cat bond. The problem with a local cat bond is that the jurisdiction has to be good for both the investor and for the sponsor. And investors might be a little bit dubious about putting their investment into a local jurisdiction where the sponsor is the government that controls that jurisdiction. Pretty much, I cannot imagine a circumstance where it wouldn't be a lot easier, certainly to attract investment, to use an established jurisdiction. But one needs to look at those jurisdictions to determine which of them fulfills the requirements that one has for an appropriate jurisdiction for one's own cat bond. Now, for me as a lawyer, the most exciting things about cat bonds are the triggers. That is, the event that kicks off the payment under a cat bond. These are the things that one spends the most time negotiating and drafting, and they are absolutely key. Most insurance company cat bonds have an indemnity trigger. That means that the insurance company has to suffer a loss, and then there is a payment up to the level of that loss, and there's a limit as to how high that indemnity can go. That's the most usual method. Another method is an index trigger, an index based upon reserves that insurance companies across the board have applied to an event. So if, for example, a hurricane occurs, insurers report the reserves they're carrying, and then a company like Verisk, an indexing company, will maintain an index to show what the likely level of loss to the industry will be, and the trigger is dependent upon the industry loss. Now, neither indemnity nor index triggers are much use to sovereign risk for a number of reasons. Sorry, the other risk is a double trigger, where you utilize both an indemnity and an index trigger. Those are frequently used on industry loss warranty contracts. they are used as are both indemnity and index triggers by insurers. They are not so useful for sovereign risk. And the reason for that is quite often there isn't enough insurance around for there to be any form of indemnity trigger, nor for a reliable index to be developed. And therefore the third form of trigger that one looks to is a parametric trigger. That is a trigger based upon the level of an event, a disaster or catastrophe. That is, for example, a hurricane of a certain magnitude making landfall in a certain area, an earthquake at a certain level of the Richter scale occurring in a defined area. It could be the amount of flooding that occurs. It could be the amount of acreage of land destroyed by wildfires. Any of those things could be the basis for a parametric trigger. And that's the most useful and likely source of a trigger for a sovereign risk catastrophe bond. When looking for a parametric trigger, there are some very important things to bear in mind. Firstly, it must be modelable. You've got to be able to model what the likelihood of that trigger occurring is, because if you can't, it's pretty useless. It's got to be definite. You've got to be able to define it with absolute precision. Again, because if you cannot, you could get disputes as to whether or not the trigger has occurred. Thirdly, it's got to be easily determinable, ideally objectively. Something like the magnitude of a hurricane is easily determinable and objective because there is the National Hurricane Center in the States that produces data on that. Earthquakes, very easy because there is data on earthquakes from around the world that can be discovered in real time. When it gets to flooding, when it gets to wildfires and certain other types of catastrophes, the ease of determination and the objectivity of the determination will be issues, and those are things that one has to look at very, very carefully when constructing the catastrophe bond, right from day one, because those are important for the modelability of the cat bond. Also, it's important to note that the trigger must be free from interference. This is very important for the investors when dealing with the sovereign cat bond, because if the government can in some way interfere with the trigger event being reached, investors aren't going to want to invest. For example, if the government operates sluice gates, any parametric trigger based upon acreage of land that is flooded could be interfered with by that government. And one has to build into that trigger something to give protection to the investors so that they can feel confident that a government is not opening the sluice gates to flood a greater area than it otherwise might have done. And then this is where people like me come in. The trigger must be properly defined. It is absolutely key that that trigger is worded in a way which leaves no ambiguity whatsoever. So that's a very, very quick run through on some legal issues that exist. I could talk for hours on this subject, and many times I do talk for hours on this subject, but our time is limited, and you've got a far more interesting talk to come now from Despoina. Oh, sorry, wrong one. Oh, sorry, I have to open it. Sorry, I've now lost it. No? Aye. Yes. Phew. I apologize for this. It's my inability with technology. Now we're here.
Hello, thank you very much for giving me the opportunity to talk today about catastrophe bond pricing. As rightfully Kirill said, I'm doing my research primarily on catastrophe pricing, and as a result, I'm very, very glad to be able to share some information with you with regards to this topic. I would like, before I start, to give you a brief idea of the structure of this small presentation on the topic. First of all, I would like to bring awareness of as of what do we mean when we use the word pricing. Secondly, I would like to focus on what do we try to calculate as a price in a catastrophe bond context. And later on, I would like to bring some awareness about academic research in the field of catastrophe bond pricing. So let's start. Talking now about pricing, there is not one definition about what pricing means in the financial and insurance markets. Depends on the context in which this word is used. In this presentation and in the context of catastrophe bonds, we are interested into the pricing at the time that the catastrophe bond will be issued. We don't care about the secondary price when it will start closing. What investors are interesting, so the primary pricing problem in the catastrophe bond context is the calculation of the spread. In the next slide, I'm going to show what do we mean?
Simona, we don't see your slides.
We see the mouse,
Oh, I'm so sorry.
the mouse was there.
We
So
can see the
something.
mouse and the screen.
Let's try.
Again.
Drag it to the right.
Can you see now?
Yes.
Okay, thank you. I'm really sorry for this technical issue. Yeah, it's on the right slide where it is to see an image. So in order to understand what spread is, we need to look at what Kirill and Clive said, like about the coupon payments that investors receive when they decide to buy a catastrophe bond. Investors care about is the coupon payments, how much earnings will be received by holding a bond, as opposed to the capital that they have invested into this transaction. The coupon rate consists of two parts, of the risk-free rate and the spread. The risk-free rate, you can think of it as the return that the investor earns just because the collateral is invested into some very low-risk investments that give something little for them as a payment, as a compensation. The other part of the coupon rate is the spread, which is what we're interested here. The spread compensates the investors for the insurance risk element that they undertake. That's why it is so important. The spread itself consists of two loss, and the other one is an excess return, which is called a loading. The expected loss basically is it shows the average loss that an investor can expect to transpire over a given period. Again, given the amount of money that they have invested into the catastrophe bond. Now, how do we calculate the expected loss? Because we're talking about catastrophes, which are events of very low frequency and very high severity, there is not enough historical data that we could use as in other classes of insurance, such as car insurance, for example, to identify easily what the expected loss would be. Oops, I'm sorry. As a result, we need some probabilistic models to assist us with this task. These models normally belong to some independent risk modeling companies, which is not necessary in all times. Sometimes the issuer may have their own internal model for that. And the whole point using these models is to calculate the frequency and the severity of the risks. What do we put as an input into these models? What we need is data. So the government or the sponsor generally that wants to issue the bond needs to be able to provide the inventory information about the properties that are insured, that they want to gain coverage for, So what is the value of the actual property? What is the value of the contents? Any business interruption values? The materials from which the building is built, the year of construction, and so forth. So also now we think, okay, this is what we put into the model. What do we get out of this model? Is a variety of metrics. We have the most important one, which gives important information to investors, which will help them decide whether they want to make an investment or not. So one of the most important metrics is the exceedance probability curve. What does this curve show us? It shows us the probability for certain levels of loss being exceeded in a given period if the insured event occurs. It's very important because it gives us an opportunity to calculate two measures, which is the attachment probability and the exhaustion probability. The attachment probability shows the probability that the investor will start losing the first dollar. So as you can understand, this is crucial for the investor to know when he will start experiencing loss. And the exhaustion probability tells us what is the probability like for the investor to basically experience a total loss. Having talked about the expected loss, let's go back now to the second element of the spread that we said that is called risk load. The risk load, as we previously mentioned, is the required margin. You can expect that the investor wants to make some money by investing. So just by charging how much they would expect to lose, it wouldn't be profitable. So it needs to have something on the top. The load, it's a non-constant figure. So it's a function. It's a function, first of all, of the expected loss itself, because one needs to bear in mind that expected loss is just an estimate. We use models to calculate it. As a result, there is model uncertainty associated with this estimate. And also, it's a function of the peril zone. We've seen that in peak zones, such as US wind, let's say Florida hurricane, normally it's associated with higher loads compared to diversifying peril zones, such as Turkish earthquake. This is something that Kirill talked about it earlier, because they can achieve with peril zones that are more unique, they can achieve bigger diversification into their portfolio. As a result, they may be charging less load. And a third factor that is very important is the market cycle. As it's known, the insurance and reinsurance markets have some periods of higher profitability and lower profitability. Normally, after the occurrence of many catastrophic events, you see that the premiums are rising up, and this is something that affects the loading of catastrophe bonds also. How do we calculate now the risk load? There is no single answer for this, because the reality is that there are various calculation principles that they are used. They are all scientific, but it depends, they have advantages and disadvantages, and it depends really on the purposes, what the issuer wants to achieve, what class of risk do you try to transfer. Just to give you a small example, one calculation principle would be not to have loading at all. Of course, this is not very realistic in real life, because you cannot really charge only what you're expecting to lose. But it could theoretically happen, mathematically happen. Another principle could be to use the standard deviation of the expected losses or the variance of the expected losses. So again, there is solutions, but it is what it will be used as a load depends on basically the issue. Now I would like to talk a little bit about the strands of academic literature related to catastrophe bond pricing. At the very beginning, people wanted to model catastrophe bonds as they would for an ordinary derivative product. So they have been trying to apply an option pricing theory. The main idea about option pricing theory is to assume that the financial markets are complete, which means basically that the underlying asset of the derivative product can be traded. So if, for example, you have a stock of Marks and Spencers, you can trade it. It's something you can trade it. The reason why this works received some critique later on was because in catastrophe bonds, the underlying risk is a disaster. You cannot trade earthquake as you would trade the stock of Marks and Spencer. As a result, academics started thinking of using a different methodology that doesn't assume that the financial market is complete. So this brings us to a complete market setting. Here, we will not be able to get a unique price of a new catastrophe bond that is issued, but what is important is that we can get an individual price for every investor based on the portfolio that the investor holds already, and we can identify what is the minimum price that an investor would accept for a transaction to happen, for him to accept to buy a portion of the catastrophe bond deal. The third strand of the academic literature is based on using real data from previous catastrophe bond transactions. So they would get information about the price additions, the peril that is covered, the territory, and the trigger, as Clive mentioned earlier. This is very, very important. And they will try to identify which factors are more important, affect the spread the most. So the majority of these models, we're trying to explain the spread, to explain how does the universe has generated catastrophe bond prices. At the moment, we see that there is a shift in the academic literature into using real data, but having as a goal to predict spread rather than explain it, which is more a philosophical question. At the moment, this is what I am working on with my team at the London School of Economics. We're trying to predict the spread at the time of the issuance and calculate the importance of predictor in prediction using a machine learning tool. So closing, I would like to make some remarks. First of all, I would like to reassure that indeed catastrophe bonds is not a rocket science, and the pricing at the very beginning it was considered quite tricky because people were not understanding maybe how simple the security is and the individual characteristics that it has. So pricing solutions are available and they are improving day by day. And it's very important to have academic interest into this field because it allows for dialogue and for finding the most appropriate ways to price these securities. And this does affect the success of catastrophe bonds also, because if the pricing is correct, it means that the investors will feel confident to invest into these securities. And as a result, more and more governments would be willing to issue these securities in order to protect themselves against serious catastrophes. So this was a small presentation. I'd be happy to accept any questions, or if you require more information with regards to the literature, or you want further information in general, please free to email me. Thank you very, very much.
Thank you very much, both colleagues online and Kirill here. Let's see if we can limit ourselves to 3 questions. Okay, please.
Thank you very much. This sounds very interesting. However, if I build a house in a normal location, I will get an insurance against flooding for the house. When I build the house in a floodplain, I will normally not get an insurance because the insurances say this will be flooded too often, so I don't give you the insurance. I'm wondering, for these questions now, can you really cover everything? Like, can you insure Chile against tsunami risk, which is very high, with very high sums of money that are being given if that happens, when the probability is still very high?
Without wanting to go into pricing, because that's obviously not my area, but anything can be covered at a price. But the price quite often is too high for the person who wants to purchase it. You can insure a house in a floodplain. It might just be too expensive to insure.
And thank you, Clive. And from the pricing perspective also, normally to insure something, you need to be able to have a model to calculate the loss. Generally speaking, you cannot really, insurance companies are quite proactive. It could not be that they understand all types of risks yet. But they try to price them in the most appropriate way based on their current understanding, whilst they are having teams building up the modeling better. But for tsunami specifically, I think that there are solutions, there are models available for this particular risk.
Okay. Thank you. Other questions? Well, thank you very much, both Clive and Despoina online. I think it was very interesting, at least for me, although I'm not listening it, at least part of it for the first time. Very interesting insights. I don't know, how do you say goodbye? Disconnect. But thank you once again, and we will share the presentation and also your contacts for follow-up questions if there are some. Okay?
Thank you very much. Bye-bye for now.
Thank you. Bye-bye.